Demonstrate a feature of Option Master Chartist that's not available on broker platforms, although it should be available for any broker that sells options or deals in options. And it's called a profit card. But let's demonstrate it by an example. A short time ago we talked about a trade in EW, Edward Life Sciences. We were looking to make a long trade. And what we did was we looked through and we found that the August 19th expiration, which is the regular August expiration cycle, had the best liquidity in the relative near term. So we did an option spread. We bought the August 19th 100 call, paid $657 for it. We sold the August 19th 105 call and received a credit of $417, which resulted in a net debit. We paid $240 for this long spread position. So let's put that in the profit card and check it out. Okay, we bought the 100. We sold the 105. They're both calls. We paid a debit, so you enter a minus sign. We paid a debit of $240. If we click this mark, it will display the results in dollars. Now this is going to display the option trade results for this, at different stock prices. And we'll start the stock price at 99. It's going to increment by $1, and it will fill in each of these columns or rows. So we'll calculate. Okay, so now we can see the original trade would not turn a profit until the stock was between 102 and 103, and it would be 102.40 would be the exact number. But just remember that it was 102.40 is the break even, and we would start realizing the maximum profit on the trade of $260 once the stock price exceeded the strike price of the short option at 105. So those are just two things to remember. One is the break even was 102.40, and the max profit of 260 would come into play when the stock price exceeded 105. Now, one thing we talked about was financing the cost of the long call spread by selling another option. In this case, we're going to sell a put, the 95 put, and the 95 put was selling for $300. So we sold a 195 put for each spread and received a credit of $300. We had paid $240. We received $300. So we had a net credit of $60 on the trade. So let's add that in. Okay, the other sold option was the 95, and it's a put, and we received a credit of 60 cents or $60. Now let's change the stock price and start the counting from, say, 94. Okay, everything looks right here. Calculate, and we can see that our break even now has changed from 102.40 down to less than $95, and that we start receiving what was the max profit under the just the spread alone at $102. And remember, before we wouldn't start realizing the max possible on that spread until we were over 105. So selling the put to finance the long call spread has lowered our break even substantially, and also lowered the amount where we would begin realizing the maximum profit. But in addition to that, let's just flip this out to 2 points per row. We can see that our max profit is up to $560 once you account for the $300 we received for selling the put. So just a simple explanation of a pretty straightforward trade, not that complicated. But you can see right away that it pays to look for ways to sell an option to pay for your long your long options, whether it's an individual option or an option spread. You can see that it can make a dramatic difference in the break even and in the payback.